While millions of families around the world were sitting down for Easter celebrations, sharing meals, and taking a break from the noise of daily life, something was quietly happening inside the financial markets that most ordinary people completely missed. The stock market, which never truly sleeps even when the rest of the world is on holiday, was sending a signal that experienced investors and professional traders were watching with growing concern. It was not a crash. It was not a single dramatic headline number that forces its way onto the front page of every newspaper. It was something more subtle and in many ways more dangerous than that, because the warnings that arrive quietly, without fanfare, without a moment of obvious crisis, are precisely the ones that most people are completely unprepared for when they eventually materialize into something real and unavoidable. Understanding what the market was signaling over the Easter weekend requires understanding one fundamental truth about how financial markets actually work. Markets do not move randomly. Every significant price movement, every shift in volume, every change in the relationship between different asset classes is the collective expression of millions of investment decisions made by people and institutions who are responding to information, expectations, and fear. When professional investors start moving money in a particular direction during a period when most of the public is distracted by a holiday, it is not accidental, it is deliberate, and it is worth paying very close attention to where that money is going and what it is moving away from. Over the Easter period, while retail investors were away from their screens and trading volumes were thinner than normal, several important signals appeared simultaneously. In the data that analysts were tracking, bond yields were moving in a direction that historically precedes periods of significant market stress. The volatility index, which measures the market's expectation of future price swings and is often called the fear gauge of Wall Street, was creeping upward in a way that suggested institutional money was quietly buying protection against a coming storm. Certain defensive sectors, the ones that investors traditionally rotate into when they believe economic conditions are about to deteriorate, were seeing unusual inflows, while growth stocks and higher risk assets were seeing quiet but consistent selling pressure. None of these signals in isolation would be enough to draw a definitive conclusion. Financial markets produce noise constantly, and the challenge for any investor is separating genuine signal from random variation. But when multiple indicators begin moving in the same direction at the same time, particularly during a period of reduced liquidity, when large institutional moves have an outsized impact on prices, experienced market watchers take notice. The pattern that emerged over the Easter weekend was not the kind of pattern that suggests a brief and shallow correction followed by a quick return to previous highs. It was the kind of pattern that has historically appeared in the weeks and months before more serious and sustained market downturns. The question that matters for your money is what this actually means for you, and what, if anything, you should be doing differently as a result of what the market was quietly communicating while most people were not watching. The first and most important thing to understand is that a warning signal is not the same as a certainty. Markets have produced false alarms before, and they will produce them again. The investors who panic sell every time a concerning pattern appears in the data consistently underperform the ones who maintain their positions through temporary volatility and emerge on the other side with their wealth intact. Reacting to every signal with dramatic action is itself one of the most reliable ways to destroy long-term investment returns. But ignoring warning signals entirely, dismissing them as noise without any serious consideration, is equally dangerous. The investors who suffered the most severe losses in every major market downturn in history were not exclusively the ones who made bad investments. Many of them were people who had made reasonably good investments, but who had taken on too much risk relative to their actual ability to absorb losses, who had no plan for what to do if markets moved against them, and who had never genuinely asked themselves the question of how they would respond if their portfolio dropped 20 or 30% in a short period of time. The Easter market signal is a reminder that this question deserves a serious and honest answer before the moment of crisis arrives, not during it. The most constructive response to what the market communicated over this holiday period is not to sell everything and move to cash. It is to review your current position with clear eyes and ask some specific and practical questions. Are you holding more risk in your portfolio then you could genuinely tolerate losing if conditions deteriorate significantly over the next 6 to 12 months. Do you have enough liquid reserves outside your investments to cover your essential expenses without being forced to sell assets at a loss during a downturn? Are your investments diversified across different asset classes and geographies in a way that provides real protection rather than the illusion of it? Have you looked at the quality of the individual stocks or funds you hold and assessed honestly whether they are the kind of assets that recover strongly after market stress or the kind that permanently lose value when conditions turn difficult? The stock market sent a warning over Easter that most people missed because they were not watching, and because it arrived in the quiet language of data rather than the loud language of crisis. That is exactly how the most important financial warnings always arrive. Not with a siren, not with a headline that is impossible to ignore, but with a pattern visible to anyone paying attention that says something has changed, and the people who act thoughtfully before the crowd realizes it will be far better positioned than the ones who wait until the danger is impossible to deny.